Very good evening, one and all. This very cold, damp, chilly night here in central Cape Town. It is July the 3rd. This is my second webinar for RandSwiss. So many thanks to Gary Boysons and the team for allowing me to do this on their behalf. I think tonight I'm going to run through a combination of factors which seem very pertinent, given we had the election literally a few weeks ago. Then the uncertainty regarding the directionality of a currency, and then of course the composition of a government, which has only latterly in the last few days been sorted. Although I understand those of you in Gauteng are still deciding which way to go. But I think before I came on online, the DA has decided to withdraw from the Gauteng provincial government. So we'll see what effect that has on the currency and the markets tomorrow. But I want to start off by firstly wishing you all very well. Hopefully the GNU year we have ahead, excuse the pun, will be a good one. It certainly has been in the aspect of the small to mid-cap market that I have been following for the best part of 30 years. The Q&A box is open, so please drop your questions. And then towards the end, if there's time, I know that Pascal has a very tight rein on this presentation. I'll try and answer as many questions as I can. As always, if my voice gets a bit croaky, I will sip some water and then come straight back. So let's do a deep dive into what's been going on in the last few weeks. Now, we all know the election happened towards the end of May, and there was a great deal of uncertainty regarding the underlying composition of the government and whether the ANC would get any form of majority. And as we've now seen, a coalition of parties have come together to form a government of national unity. And as that coalition has basically been cemented down, the domestic market has clearly taken that to heart. So I'm looking at some data points, which I drew up before I came on air with you tonight. And since the 30th of May, the small cap index of the JSE is up 9.7%, and the mid cap index is up 7.4%, showing you that the rush into the domestic sector of the JSE has been quite evident. But drilling down further, there's been some very, very interesting dynamics that I've seen. From the 17th to the 19th of June, the small cap index, literally in a matter of 2 or 3 days, jumped 6.3%, as if everybody suddenly realized the place to be was these undervalued small caps. Even more interesting is that post the election, the mid-cap sector, which is where you have your larger, more liquid stocks in the domestic environment, I thought would do quite well. They actually fell 1.3%. Then only from the 10th of June did they then rally to today 10.1%, which is quite staggering. So I think what we've clearly seen is as the stability has returned to the JSE, and of course to the political environment, and investors and the greater world has potentially seen stability coming to the country, and hopefully some policies put in place for economic growth, infrastructure spending, employment growth, potentially lower interest rates, and all the good things that investors look for when they're investing in an economy. They've clearly taken a headlong rush into what I would call the better quality mid-cap sector of the JSE. That is predominantly because that segment of the JSE, the mid-caps, are far more liquid. They tend to attract a certain sphere of investor, the large institutions, and of course the international players who are looking to invest in this country are hopefully on better news. So whilst the small cap sector in the period since the election has done better than the mid-cap sector has done specifically better in the last 2 to 3 weeks, perhaps as the greater institutional market and the international players have decided where they want to position themselves. And I think that's going to be the tack going forward, is that the mid-caps will continue to be the place to be purely because of liquidity. As I said to a client of mine this morning, if you wanted to come in right now and buy 50 million rand of one of the really good quality small caps, like Argent Industrial, whose market value is 1.2 billion, you would struggle to actually pick up that much volume of stock. But in some of the larger stocks like Advotech, Reunert, Premier Holdings, etc., you could easily pick up 50 million rand, if you were patient over a number of days. And I think that'll be the tack going forward. Now, that's one of the reasons when I put out my top stocks of 2024 back in early January. For many years, when I've been doing this composition for my institutional clients, I have generally tried to pick small cap stocks. But going into the uncertainty of the election period at the start of this year, and of course, the rand volatility and the underlying weakness in the economy, both from an industrial, mining, and consumer base, I felt that having a portfolio purely aligned to small caps would not be the best course of action because of the risk associated with the liquidity and the domestic exposure of those small caps. So I went into the arena of a better quality blue chip mid caps, which had defensive qualities, better liquidity, and I thought slightly better growth prospects in certain companies that I chose. So to run down the list, as I will go through them quite briefly in the next few minutes, we had Afrimat, Argent Industrial, Astral Foods, Curro Holdings, KAL Group, the former Kaap Agri, Libstar, Novus Holdings, Premier Foods, and Reunert. I updated my top stocks just before we came on air, and as it stands right now, they closed the end of the day at 26.66% ahead year to date. That includes dividends. The small cap index in the same period is up 12.53%. The mid cap index is up 9.21%. And the all share index, from a point of selection at the start of this year, is up 8.44%, showing you that the small cap index has been the place to be year to date, followed by the mid cap index. But my portfolio selection, when I've chosen high growth small caps and a good basket of quality mid caps, has significantly outperformed all the benchmark indices that I track. Now, running through the list, the top performer in the underlying list is print, packaging, and education company Novus Holdings. Year to date, including dividends, a special dividend of 50 cents paid in January and an ordinary dividend paid recently. It's up 55% year to date. The second best performing stock is Argent Industrial. As you know, a stock that I favored since probably March to May 2019. That stock year to date, including its dividend, is up 50%, which is a staggering achievement for a small cap. And then looking down the list, we've got Reunert up 27%, Premier Foods up 23%, Afrimat up 25%, Astral Foods up 14%, Libstar up 20%, and the worst performer, if you can call it that, only up 2.6%, including dividend, is Curro Holdings. But I'm going to run through these very briefly. I'm also going to touch on the fact that in the last few weeks, I've just come through the latest batch of reporting season, and I've probably seen over 30 companies directly. Unlike many of the commentators on social media who happily read sends and regurgitate their opinions, I'm one of these old-fashioned analysts purely because of work that I do in the institutional sector, but I physically go and see management. Granted, I have the ability to get access towards management, given I've covered these stocks for many, many years. And that, I think, gives an edge when you physically look management in the eye and kick the tires regarding results. So pretty much all the stocks that I've discussed tonight, I have actually engaged with. The Afrimat Investor Day happened in Johannesburg on the 11th of June. The Argent Industrial results were out last Thursday, and I spoke to Treef Henry. He's currently in London. The Astral Foods results came out in late May. I met with Chris Schiller. The Curro Holdings results were out in May. I met with Cobus Loubser, and I also met with Cobus literally in the last few weeks on the back of the annual general meeting. KAL Group, same thing. I met with Sean Walsh and Graham Sim, the CEO and CFO, respectively, in May. Libstar, I had an engagement with Charles de Villiers, the CEO, and I spoke to him recently in the back of the very strong 5-month trading update. Novus Holdings had results a week or two ago. I met with Andre van der Veen, the CEO, in the presentation, and I've also discussed the company with the activist investors, A2 Investment Partners. Premier Foods, their presentation again on the 12th of June. I had an engagement with management in Johannesburg, and probably the best post-results analyst call I've had with any company so far this year, and I'll unpack Premier a little bit later. And then, of course, Reunert had their results also in late May, and I had lunch with a company in Cape Town again at the end of May. So it's always nice to literally look management in the eye, pepper them with questions, and you get a far more considered viewpoint from rather than just reading a sentence and giving an interpretation. So let's start with one that is very topical, and one that I know that many of you out there in the dark listening to this presentation actually have followed and have owned for quite some time. It is Afrimat. They had a half-day investor day in Johannesburg on the 11th of June, and I flew up from Cape Town to attend. Now, the reason why I attend is because every single divisional director of Afrimat is in attendance at these meetings, and they give a very, very detailed feedback on the underlying performance of the company, and more importantly, its prospects going forward. And as I've stated on in my social media platforms and in my notes, whenever Afrimat does a pre-investor update, the stock always runs post the event, because as the market gets to see the underlying quantum of the underlying works that they're up to on a 1, 2, and 3 year view, the market seems to say, hey, we didn't know that, and the stock runs. That's exactly been the case with Afrimat. You could have bought the stock in the early 60s ahead of the result of the pre-results, sorry, of the investor day meeting, and it closed today at a 52-week high at 74.50. As I said, year to date in my portfolio, including dividends, is up 24.74%. So what did Afrimat tell me and the assembled gaggle of investors in Johannesburg? Now, much of the news is fairly positive, but as I've written in my notes, there is an element in Afrimat that will have an impact to its results to the 31st of August, which is the interim results. Now, the key to Afrimat, as many of you know, is that it's a diversified mining company, but the bulk of the earnings still come from iron ore. They have two businesses, Demeneng, which is their export business, which has a rail allocation with Transnet to Saldanha of around 870,000 tons a year, but has never been fully attained because Transnet, as we all know, quite frankly, couldn't run a piss up in a brewery, and their trains keep derailing, and they're not exactly good at moving goods around. And then Jenkins, their domestic operation, sells all its output to ArcelorMittal. And as I think we all know, ArcelorMittal has had a tortuous and very troubled last 6 months, with a threat of potentially closing down its long steel product in Newcastle. But thankfully, in today's business day, you will all have read, hopefully, the statement that they're keeping the long steel plant open. And that potentially brings some very interesting news to Afrimat, which I'll unpack just now. So even though in the last few months, the iron ore price internationally has fallen from $144 a ton down to $110 as I speak, it's down roughly 23-24% year to date, or roughly 680 Rand a ton. There will be a significant decline in the underlying profitability of all companies involved in the iron ore sector, such as Kumba and Afrimat, one, because of the Transnet issue, and two, because of a decline in the iron ore price, and of course, the slightly stronger Rand. We all probably remember that the Rand touched its weak point of around 1920 a couple of months ago, and as I stand here today, probably trading at about 1834, though it has been below 18 in the optimism regarding the GNU. But with the uncertainty we've seen in the last few days, it has weakened back again to around 1834. So also, ArcelorMittal has instituted a force majeure onto Afrimat, which basically means due to its own distress, it has not taken a single ton of product from the Jenkins mine for the best part of 5 months, which means there's a bit of a hole in the Jenkins operation of iron ore into Afrimat, and the Jenkins mine is a very profitable cash cow. So even though there's been a speed bump, or should I say a hiccup, in the underlying results to Afrimat for the first 6 months, it is certainly not something that I would rush out and headlong sell Afrimat, because the first 6 months might be slightly weaker because of a hiccup at ACML. with today's announcement that ACML is not closing its long steel plant, has got some further protection from the government. And I understand they have, or they will resume, hopefully in August, an increased volume offtake from Afrimat, albeit at a slightly lower iron ore price. Even though Afrimat will gain a slightly lower price, it'll probably fall by about 6% from a prior agreed price. They will get increased volumes. And as such, there's very strong cash flow and increased profitability from Jenkins into the Afrimat operations in the second half of the year and going into 2025, which will be good news. Secondly, they mentioned that the Unkomati anthracite operation, again, having had a few mining issues, is doing exceptionally well. They've had a ship leaving at the end of July with another very large profit contribution, which will come into results in August. And they've been able to garner an export contract via Maputo with Grindrod to send their excess anthracite of second grade into the international market. That will generate an extra bit of jam on the profitability of Unkomati, which has had a very, very strong uplift in profitability in the last couple of years. The Lafarge aggregates and cement transaction was 6 months late. It only came into the Afrimat portfolio in April. And in the 6 months delay, because of the Competition Tribunal investigation, because some errant players thought they'd stick the knife in and try and cause trouble to try and extract some of the assets that Afrimat is forced to sell due to the Competition Commission investigation into the agglomeration of the Lafarge quarries into Afrimat. Certain quarries in Hermanus, Port Elizabeth and Gauteng have to be sold, but nothing too big in the scale of things. That led to some queries from errant parties in the marketplace, and it delayed the entire transaction. That delay cost Afrimat dearly. Lafarge was rudderless, and from a business which was making at one point in October, November last year, 10 to 12 million rand a month, it's now losing between 30 to 40 million rand a month. That has to be turned around. Now, management quickly sent their top team into Lafarge, and they do expect a recovery in that business fairly swiftly, but it'll still take quite some time to right-size that ship. So again, that'll start to play in the interim results to August. So the annual general meeting of Afrimat is coming up in August, and I think they'll start to guide the market to the fact that certain operations inside the company, like construction materials, anthracite, is doing exceptionally well, but the iron ore side and Lafarge, which do have significant prospects into 2025 and beyond, will be quite soft in these 6 months. The market doesn't seem to care. It's not every day that Afrimat actually has a negative period. But I think at 74.50, whilst I have a target price on the company of 80 Rand, I certainly wouldn't be chasing it too much. I think as the narrative starts coming out in the coming month, there may be a slightly less gloss in the August results, which should be on SENS sometime in late October, early November. Then the share price might start to trend sideways. There's nothing fundamentally wrong with the business, but I would certainly use, as I would often say, a bad Zuma day, even though he's no longer in the picture, to pick up stock at weaker levels. But at 74.50, I would not be chasing it. But it's certainly not a stock that I would actively sell because I see some softness coming in the interim results. We take a sippy here. Moving on to Argent, fantastic stock, up over 50% year to date. And it's the stock that I've had a very strong conviction of for nearly 5 years, in fact, 6 years. It was March 2019 when I first went to see the stock, having covered the stock for nearly 20 years, and discovered its new genesis and the embryo of restructuring of the company. That was at 3 Rand 52. And here we now are at 22 Rand 95, sorry, 22 Rand 35. And the stock is still powering ahead and still on a P of 5. Earnings came out last week showing only a 6.6% increase in HEPS, even though the underlying profitability was up 17% in the period, with very strong cash generation, which was up 76.5%. They've got 450 million Rand in cash. which equates to about 37% of the company's market cap, or around £8.28 per share. But the UK taxman increased the tax rate from 19% to 25% in the last 12 months, and that took a fat slice out of Argent's profit, because now 64% of the company's earnings come from offshore. It's roughly 48% of the company's revenue and roughly 64% of its profit. So Argent is continuing to become a much greater rand hedge as it sells domestic low-margin businesses in the steel trading and general steel market to focus on steel beneficiation, such as expander security doors, Jetmaster fireplaces, and American shutters. They manufacture them locally, and then they then sell them into Africa and, more importantly, internationally. So I think going forward, that cash hoard of 450 million rand will be used to continue to buy offshore businesses. I anticipate in the next few months, probably another 150 million rand will be spent buying a couple more assets in the UK to keep its rand hedge exposure and profitability growing. And the company has bought back 35% of its shares in the last few years and cancelled them. They used to have about 84 million shares in issue. They're now down to about 54.4 million shares, and those shares have been cancelled, benefiting, of course, the underlying growth in headline earnings per share. So even though the underlying profit growth was quite pleasing this year, up 17%, I think now that the tax base is set at around 26% at Afrimat, and they have adjusted the underlying stratagem of the company, I'm expecting very good growth in the earnings for the year ahead. And from a base of £4.38 shown in the current financial year to March, I'm forecasting a growth of £5.10 to March 2024 of about 16%. And that brings the price earnings ratio of Afrimat down, of Argent down to around 4.4 times. So with good earnings growth, a growing rand hedge component, ongoing share buybacks, and they paid a £1.15 dividend for the last 12 months, there's nothing not to like in Argent. The only thing possibly not to like is the fact it is still a small company at around 1.2 billion rand. There are very few institutional shareholders. It is mainly driven by what I would call wealthy individuals and the private client market. The largest shareholder is Merchant West, which is a fund management company allied to the value investor Pitt Viljoen, who has a very good long-term track record. And then there are a few other investment companies domestically which hold small amounts of shares. But there aren't many institutional shareholders. And I only think once it crosses the 2 billion rand market value, having had 11 consecutive periods of earnings growth, will this company start to attract the interest of the institutional shareholder. But I think by then the stock probably will have delisted from the JSE and possibly relisted in London. And I don't think the listing in London is going to be at a 4 times PE. Even if they get an AIM average of between 6 and 8, that potentially leads to an Argent share price north of 30 rand. So I have no reason to not continue to recommend the company in the short to medium term. One of the best performing stocks in the last 30 days in my portfolio has been Astral Foods. Looking at my data points here, in the last 90 days, the stock is up 23% to 166 rand 69. Now, I find that slightly perverse because, as some of you out there may know, I'm a bit of a geek when it comes to covering soft commodities and the poultry sector. I cover it extremely closely. And even though the company has ran up 23% in the last 90 days, the underlying fundamentals in the poultry sector have not changed. So even though we have a GNU government and there is a great deal of optimism regarding the underlying economy, nothing has fundamentally changed regarding the consumer. I publish on a weekly basis the data points on the chicken price in this country. And year to date, the IQF price, which is the individually quick frozen portions, which the multitude of citizens buy in the ubiquitous 2 kg bag, is down roughly 18% year to date. And someone like Astral Foods, which generates 54% of its entire poultry production from IQF, is currently having a bit of a squeeze regarding the price. Granted, they are a very, very efficient producer, and the underlying soft commodity price, which is maize and soya, are benign and have come down quite nicely, and lower levels of load shedding again will benefit the company and the sector. At its worst last year, Astral was spending about 60 million rand a month on diesel to keep the generators going because Eskom couldn't keep the lights going. We've now seen for the best part of 100 days that Eskom has kept the lights going, and Astral's energy costs are now down to circa 15 million rand a month. And an additional saving will kick into the numbers, as will the uplift in the restructuring and the profitability of the poultry division and the animal feeds division. But I think the market has slightly run ahead of itself. Whilst I am very fond of the poultry sector, and I think it does have a place in a portfolio, to me, it's a cyclical trading stock. I will not buy a poultry company to buy and hold like a defensive food company like Premier Group, for example. With Astral Foods and Rainbow Foods, which listed on the 28th of June, which I'll come to a little bit later, you buy them when the input costs come down and they can push through price increases. And then as the input price goes up and certain elements in the market go against them, you sell. So if you overlay a price of the underlying headline earnings per growth shares of Astral going back for 15 or 20 years of a share price, they correlate virtually perfectly. When earnings boom, so does the share price. When earnings don't do great, the share price tanks. So as it stands right now, even though Astral is in my top portfolio for the year, and it's up 14.43% year to date, I will keep it in. But I think the irrational exuberance we have seen in the stock has predominantly been because, as I mentioned, many of the institutional players and the offshore investors looking to buy stocks which are directly aligned with hopefully a recovery in the domestic consumer environment have been buying into these counters, but nothing is probably going to change with the consumer sector or the consumer for at least 6 to 12 months. So I think in this case, the investors are putting the egg before the chicken. And again, whilst I like the stock, I certainly wouldn't be chasing it. Curro Holdings year to date is only up 2.6%, but at one point it was down 12%. So it's had a very, very good run. It's probably up about 10% in the last 30 days. And even though the interim results, which came out, were actually quite pleasing, and they've now had 4 unbroken periods of results, the market took a bit of a fright when year-end results came out in March because they impaired 28 schools which were not performing to meet the internal rate of return for Curro Holdings, and roughly a 380 million rand, impairment was made. That caused the share price to skid, and it's only just started to recover in the last few weeks. Now, interestingly, as I put in a note which I published on my Twitter page today, so if anybody wants to know what's going on in the private education sector in terms of Stadio, Curro, and Apotec, log onto my Twitter page, or should now call it X, but it'll all be through Twitter to me, and check on my handle @SmallTalkDaily. And I published a full note on the education sector earlier for wider universe to actually read. And in that, I stated that whilst I prefer Apotec as my long-term play, Curro Holdings, I think, has been left behind in the recent rally in the education sector, which started on the 10th of June. And I think it still has a little bit more legs. And I would not be surprised that when the results for the 6 months to June are released to the market in August, that Cobus Loubser once again comes out with a 5th successive, fairly positive update in earnings. However, the market is still fairly cognizant there is a significant capex coming from a company in this year and next year to finish off all the secondary schools, and that will have an impact to Curro, and as such dampen the profitability because finance costs will take a bigger slice of the underlying profitability. But the company is eking out extra profits from its underlying efficiency and utilization of the school, and even though they will not have stellar growth this year, and certainly growth that will not probably see a growth in underlying learners by only 3 or 4%. I think the stock trading at 11 rand 56 still has legs. But I'm going to jump fast forward. My favorite stock in the education sector is actually Stadio. I was going to talk about that towards the end, but given I'm on the education sector right now, I'll talk about it now. So I'll just flip to my notes, which I did earlier. As it stands today, Stadio closed at R5.20. Year to date, it is down 0.38%, but it is up 14.3% since the 31st of May, or a couple of days after the election. And clearly, the market sees the same potential in Stadio as I do. Now, the AGM that they put out, again, the comments are in the note which I put on my Twitter page at Small Talk Daily today. Chris Forster, the CEO, probably had one of the best presentations of all the education companies at the AGM, and there was an extremely detailed 50-page presentation which is on the Stadio website, which unpacks why the company is doing well and why it continues to expect to do well in the months and the next couple of years ahead. Headline earnings per share to the year ended December were up 19% to 24.5 cents a share, and they paid a 10-cent dividend, and they sit in a net cash position. Now, the interesting thing going forward is that Stadio is going to be building its new campus here in Durbanville, because its existing campuses in Bellville are basically busting at the seams. So the new campus will cost them around 220 million rand. So Stadio will move from a net cash into a net debt position. But compared to the money that Advotech and Curro have spent over the years in building bricks and mortar assets, Stadio is only spending a fraction of the money that those other companies have spent on increasing its underlying education footprint. That's what I like about this business. 86% of Stadio's learner numbers are actually derived online. So in the update they put out, and I've got it here, 46,300 learners to the end of June, a growth of up to 8%, which is not bad. It's one of the best growth factors of any education company in this country year to date from the AGMs where I attended. So despite the fact that the schooling sector is perhaps feeling the pressure of parents not having as much disposable income to send their children to private schooling, there are elements of the working population and perhaps those of the tertiary sector that continue to want to uplift their education levels, perhaps improve their skill set for career advancement or to move offshore, and are prepared to pay to get an education on the tertiary side or the higher education side of the near 100 courses that Stadio currently offer. They indicated at the AGM there's another 34 courses yet to be approved, and that'll power earnings into 2025 and beyond. So Stadio is an asset-light business. They are extremely confident of basically getting to their target of revenue and profitability and learners by 2026, and continuing to grow that base. The Centurion campus is growing in leaps and bounds. It's up over 50% in learners year to date. The Durbanville campus they expect to open in 2026 with 1,000 learners, and that'll potentially get up to 5,000 learners upon its completion. And the underlying business is actually performing extremely well. So I expect that modest debt situation, which could potentially be between 150 and 200 million rand, which is insignificant in the greater scale of things in the market cap of Curro and its net asset value, I think will be repaid very quickly. And more importantly, Chris Forster at the AGM said there will be no change to the dividend policy of Stadio. So despite reasonable capex and then moving into a modest debt situation, they will still show earnings growth and dividend growth. So at R5.20, with a stock up 14% in the last, call it 6 weeks or so, I forecast the stock could potentially go to R6.50. I anticipated the stock to break R5. It did. I think it wants to break R5.25, and if it breaks R5.25, it'll move higher. Now, certainly, this is not a stock that I would certainly put in for widows and orphans. It's a great stock, and in an education portfolio, I'd probably always have Advotech because of its diversity between secondary and tertiary and offshore education businesses. But for a pure play on long-term growth in education with a low asset base and an exponential growth potentially in the online business at very little incremental cost, I would happily own Stadio in a portfolio. And I bought some Stadio literally about a month ago, under £4.90, and I'm very happy that my little portfolio has them. As always, do your own research, speak to your broker, read through the results, but I have Stadio as one of the 2 new buys in this webinar, and I think hopefully when I talk to you again in 3 months and in 6 months, it'll have performed quite well. Moving back to my little list as I take a sippy. 7:05. So I'm going to quickly rattle through some of the other holdings. On that play on words, I'm going to go to the best performing stock in my portfolio year to date, which is Novus Holdings, the print, packaging and education company, whose market cap is now over 2 billion rand, and that is extremely important. As a leading fund manager told me about a fortnight ago, above 2 billion rand, funds can now actively invest in the company alongside unit trusts who are normally precluded from investing in companies with a market cap below 2 billion rand. Novus Holdings had extremely good earnings, which came out a couple of weeks ago. They were up nearly 1,000% to about 78 cents a share. They reported a 50 cents final dividend, and that goes along with 50 cents special they paid in January. So from a share price, which is currently trading at £5.75, you've got a rand in dividend this year and capital growth. And since the activist A2 Investment Partners took control of this company just around 3 years ago, you've had £1.90 in dividends paid out, and you've seen the share price go from £1 to £5.75. So it's been an astonishingly good performer, and one that I've recommended since April 2021 at £1.40, and I have no plans to change my recommendation. Even though the stock has recently made my £6 price target, I did upgrade it in June to £7.50, and I think moving into 2025, given the 78 cents a share base that Novus currently has, and the anticipated growth that the company articulated at its results presentation from its investment in the education sector and the stabilization and modest growth in the print and packaging sector, which again is seeing fairly niche growth in certain quarters, the stock hopefully will show very good growth again year on year. So I believe it'll probably show earnings north of £1 to March 2025, and at £5.75, with the prospects of extremely fat dividends going forward, it's one that I have no hesitation in continuing my buy recommendation. I always caveat that when a stock has run so quickly, so fast, with its up now 55% year to date, the easy money has been made. Do not expect to go out and buy the stock tomorrow, hoping for another 55% in the next 6 months. It probably is not going to happen. So once again, it's one of those stocks that I think in a small to mid-cap portfolio should do well. And as I wrote in a Financial Mail article in June, I would happily have Afrimat, Reunert and Novus as growth stocks in any small to mid-cap portfolio, or as a small percentage in any underlying equity portfolio investing in the JSE. All have got extremely good management, great growth prospects, encouraging recent results, and there's nothing in the underlying narrative or optics that leads me to believe that they will not continue to perform. And as I said, Afrimat, Reunert and Novus have all recently hit 52-week highs, clearly demonstrating that the wider market is now agreeing with me, given that I've had buys in these stocks for quite a number of years. So Novus to me is one that I will continue to hang on to. Now I want to talk about Premier Foods. Premier Foods is the country's largest breads business, and I think it's a stock that has been a fantastic performer for me. I chose the stock beginning of the year at 62 Rand, with a 72 Rand price target, which wasn't very aggressive, only about 17%. Today it's up 74, it's up trading at 74 Rand a share, and it's paid a 2 Rand 20 dividend, which came out on the 12th of June. And year to date, the stock is up, as I'm looking here, at 22.9%. I was fortunate enough to have an extremely enlightening conversation with management post the results. And I can tell you, as an analyst that has been around the block for over 30 years, it is probably one of the best feedback sessions that I have seen or attained from any company in reporting season this year. Management are truly on top of their game. They know exactly what is going on in their marketplace. They know exactly what the competitors are doing, and they know where to invest to extract profits and to maximize margin appreciation. I've gone on public record by saying it is possibly the best management team in the food producer sector currently, and I'll tell you the underlying reasons why now. Even though bread is a very emotive subject, and it's very difficult to try and pass on price increases, because bread is the product that is bought by the poorest of the poor alongside the affluent. It's a staple daily product. You have to be the lowest cost operator to actually maximize your margins and show profit growth. Premier do it extremely well. They've invested very heavily in consolidating some of their smaller, less efficient bakeries into these giant bakeries that can produce up to 16,000 loaves an hour. And as management say, every cent you save on a loaf, if you're producing 16,000 loaves an hour and hundreds of millions of loaves a year, heads into the bottom line. But the two biggest input costs in making a loaf of bread are quite obvious. One is wheat, and wheat year to date, as I again check my notes here, I was checking earlier, is actually down about 10% since the end of May, and that'll start to feed through into the underlying production cost to Premier in the next quarter. The second biggest cost inside a milling or baking operation is fuel, because they use coal, diesel, and gas to heat the ovens and to prove the bread. And of course, if you're distributing bread, which Premier does to over 70,000 points of sale a day. Now imagine that this company goes to 70,000 different locations a day to deliver the humble loaf of bread. You have to be extremely efficient in order to manage your logistics network, your drop situation, and of course your production to make money from a loaf of bread, and Premier do it exceptionally well. Profits year to date were up over 35% on the normalized HEPS level. They also announced the 30% acquisition of a rice business in Durban called Golden Keys, which they anticipate expanding nationally. They're on the hunt to grow their grocery business, which is probably currently only in the confectionery and certain small consumer products. And this business has also repaid R1 billion of debt from the special dividend that private equity Brait extracted when they listed the company over a year and a half ago. So the lower debt situation will aid the company's finances. And of course, we saw a couple of months ago, Brait, who is the single largest shareholder in the company, and that company is controlled by Christo Wiese, the billionaire ShopRite and Pepco owner. He sadly had to allow Brait to sell a number of shares to raise money to repay their debt, and that weighed in the share price. The share price fell from 74 Rand down to 60. They placed the shares at 60 Rand, and it has since rebounded very quickly. But management stated on the results call that Brait will no longer sell any further shares. Christo Wiese will not allow it. And as such, that liquidity event has been removed from the marketplace. So even though Premier has made my price target of 72 Rand and is now trading at 74, I'm working on an updated note in the next couple of days, and I will certainly be increasing my price target. I would be as bold to say that Premier currently is possibly one of the best positioned food companies in this country for the next 2 years. And if the economy starts to turn around, if the consumer starts to get a bit more money in their pocket, If price increases start to be implemented, a 5% price increase in bread was pushed through in May, then the company, on its expansion and on its efficiency, which will only start rearing its head in 2025 as these new mega bakeries start coming on stream, should show continued earnings growth and at least 2 to 3 years ahead of the competitors. Both Tiger Brands, who own Albany, and unlisted Premier Foods, which owns Sasco, are behind the curve, and they have to invest billions to upgrade their underlying bakeries. But Premier did it years ago, so they're well ahead of the pack. So I expect a good earnings rise, excuse the pun, from Premier, and it's one that I would absolutely want to hold in any quality small to mid-cap portfolio. And I'd be as bold to say it would be a core holding of any growth portfolio going forward. It is now coming up to 7:15, so I'll quickly check what questions are coming in. Let me move that to one side, so I actually have it for later. And where is that little box? And then I'll quickly touch on some other stocks that I wanted to comment on. The other idea that I had, and I've given you Stadia as one of my other ideas for the next 6 to 12 months on this webinar, is I want to talk to you about a very small company which I think has a very interesting place in certain niche portfolios. For dramatic effect, I'll take a sip. That is a small cap company called Frontier Transport. The company traded at R6.61. The JSE ticker code is FTH. They're 86% owned by Hoskins Consolidated Investments, which means that liquidity is quite tight. It's a 2.175 billion rand market value company. And on the last 3 years, the stock is up 113%, and they pay extremely generous dividends. Headline earnings, which came out for the year ended 2024, were up 38% to R1.32. They paid a 48.4 cents final dividend and a R1.37 special dividend, giving you the current share price a yield of 30% on the company. This is the second successive year that they have paid a special dividend. The company generates very good cash flow. So what do? If you live and travel around Cape Town, Frontier Transport will be known to you. They operate the Golden Arrow transport bus service here in Cape Town. They also have the My City bus network. And the key to this company is efficiency. So in the last few months, as the diesel price has come off its highs, they actually make money from being far more efficient in utilizing their virtual 1,000 fleet business to transport about 250,000 people a day around Greater Cape Town. They've also maximized the level of optimization from their fleet, which means these buses are more efficient regarding moving people around by removing routes, optimizing the amount of time and amount of driving the buses do. And thirdly, putting technology into these buses to actually generate more fuel efficiency. So any of us driving modern cars have stop-start features. So if the bus stops, now the engine kicks off to save fuel. If the bus idles for more than 2 minutes, it stops. The driver cannot floor his foot to make the bus go fast, slow, fast, slow. It's more of a steady state, again, optimizing the fuel. So in the last 12 months, Frontier Transport has saved a great deal of money through fuel optimization, and that has kicked through into its earnings. They've also seen a 2% uplift in the number of passengers using the domestic bus network as the back to work scenario continues to creep in after the COVID pandemic, and more companies demand that their staff come back to work. And more interestingly, in the next few months, they're going to be importing 120 electric buses from BYD in China to actually start a very aggressive replacement of their domestic fleet, moving away from diesel buses towards electric. Now, it will take a number of years to eventually convert all the diesel buses into electric buses, but they're starting off with a bang. There will be a significant capital cost in the first 120 buses, which cost around 4.3 million rand each, compared to a 3 million rand cost of a diesel bus. But here's the interesting part. The only things that wear out on an electric bus are the brake pads and the tires. And the cost of operating an electric bus per kilometer is only 30% of the cost of a diesel bus. And a diesel bus needs maintenance on the engine and on the underlying bus because it rattles itself to basically failure. You do not get that with an electric bus. The battery lasts 8 years and it needs very light maintenance. So all in all, the underlying benefits that will accrue to Frontier Transport from its eventual conversion from a diesel situation to an electric situation, and more interestingly, it has installed 5 megawatts of solar panels on its depots and its head office to power its own buses from its own self-generated capacity, and it's signed deals with independent power producers here in the Western Cape and with Eskom to use off-peak nighttime electricity, which is cheaper, to try and generate greater profitability from its bus fleet going forward. Now, there is a very strong caveat to this special situation. Frontier Transport is 86% owned by HCI. There is very tight liquidity. It pays good dividends, but that is not assured. HCI is generally demanding very strong dividends to meet its own requirements to run the business and to service its own debt. But with the very significant capex coming from the electric bus investment in the next 12 months, there may not be a special dividend coming in the next 1 year or so, just ordinary good dividends. So I would expect dividends in the next 12 months to be around 55 cents a share, which will be which of a current share price should give a dividend yield of around 8%, bearing in mind that special dividends should then start to accrue going forward. So for those funds out there that are looking for what I would call a stock that will enable you to sleep at night, knowing that this very seasoned, mature management are extremely astute operators in the public transport business who've generated very good returns for shareholders over the last 3 years. As I've said, 113% plus very fat special dividends on top of that, with a very conservative balance sheet and potentially some corporate action going forward should HCI decide to either buy back the business to capture the special dividends for itself, or perhaps unbundle the company to create greater value for itself and its underlying union shareholders. Frontier Transport, to me, is one of those stocks that I would happily own if I was an investor looking for long-term dividend and earnings growth alongside a nice, steady, if not staggering, growth in capital appreciation. So my 2 new ideas for this 6 months is Stadio at 5.20 rand and Frontier Transport at 6.61 rand. Both have their pros and cons, and as I have to always state, these are my personal views. I would absolutely advocate that you speak to your direct broker if you have a brokerage account, and for those who do their own research, to read the annual report, to look at the recent results and formulate your own opinion. Do not solely go what a pundit says to you on Twitter. We all know that despite what we say, everyone spending their own money should do their own research. So in closing, as it stands right now, and looking at my top 9 portfolio, I have no desire, not that I'm able to change any of the stocks. We've seen very, very good growth in the better quality blue chip mid-cap environment over the last 2 to 3 weeks. I anticipate that will continue. And as the formation of a government actually starts to settle down, and if Iran starts to behave, and if we get some reasonable economic policy and reasonable economic thinking coming out of this government of national unity, what we could then see is the greater international emerging market funds coming into the JSE. we've already seen in the last couple of weeks that underlying volumes of the JSE have picked up quite nicely. The foreigners aren't really in the market yet. But again, having covered this market for over 30 years, I do know but if and when they do come in, the first thing they start to go for is the more liquid blue chip mid caps, which have market valuations north of $500 million. So those companies that are worth 5 billion rand or more generally attract better international interest than the ones below that. So the likes of an Afrimat, Astral, Curro Holdings, Premier Foods and Reunert will clearly, alongside others, be on the radars of international emerging market funds should they come in. So on that note, it's coming up to 7:25. Not many questions coming through. So let me have a little looky and see what you have to say here. Bear with me a second. Purple Group, not a stock I've ever covered. I've steered clear of that because there's too much interest from the easy equity crowd, and covering Purple would be like cutting my own throat. So I've never covered the stock. I've never engaged with Charles Savage. I am an easy equities account holder. It's done me extremely well as an investor, but I do not cover Purple, and I have no interest in covering it. Omnia's recent results. Again, Omnia today hit a 52-week high. Now, I've had many clients bitch and moan to me in the last few months that Omnia was not performing well. But in the last month, the stock is up very, very sharply. You could have bought Omnia literally about 6 weeks ago in the early 50 rands. Now we're in the 66, 67 rand range. And they've paid out a 5.75 rand dividend, including which was a special and a final dividend. So we've had a very, very good capital appreciation from Omnia. The key thing from Omnia, operating in the agricultural and explosive sector, is it's expanded internationally in the mining business, which is continuing to do very well, particularly in Indonesia, growing markets in China, in Southeast Asia and in Australia, and of course in North America, particularly in Canada. The agricultural side is also doing very well, again, internationally. And domestically, the boom and bust cycles we have seen in the fertilizer price has been completely smoothed out because of the way that Astral actually operates its business by being a producer of ammonia and actually having the ability to convert that ammonia into value-added products. So even though the cyclicality in Omnia will always be there regarding the agricultural sector, regarding the amount of hectares planted and the demand for fertilizer from farmers in this country where Omnia makes the bulk of its money. With specialized farming and the technology that Omnia has basically implemented, there's a lot more, there's a lot greater improvement in the underlying quality of the business. So the cyclicality has gone from this to this. And as such, I think the market is now beginning to realize the boom-bust scenario in Omnia has been tempered. And my standing target in Omnia has been 80 rand. Would it get there? Who knows? But I think into 2025, if this agricultural season this year, which has seen the commercial maize crop fall 19% to about 13.4 million tons, starts to move from an El Nino situation this year, which is hot and dry, back to a La Nina situation next year, which is wet and less hot. We could see farmers planting more maize and greater demand for fertilizer. And with the base for fertilizer having settled down after the boom-bust from the Russian invasion into Ukraine, Omnia to me still looks interesting. And as I've said, the market is clearly reacting to the recent results because it's up quite nicely in the last month or so. Let me, what's this question here? Okay. About Argent, do you think they can find reasonably valued companies to buy? Do you think they have a history of not overpaying? They do have a history of not overpaying. That's good. But can good and cheap companies be found, especially in the UK? The answer is yes. And I can say that with a certain degree of confidence for very simple reasons. Most of the companies that Argent has tended to buy in the last few years have been actually quite small. They've never really bought a company that's greater than a few percent of their entire market cap. So when entrepreneurs basically want to sell their business, be it for death, divorce, retirement, or for whatever reason, they generally do not find private equity buyers because the companies they sell tend to be quite small. For example, many companies that Argent have bought in the UK make profits between £500,000 and maybe £5 or £6 million. Now, the greater scheme of things, when you transfer that back into rand, it is a nice sum of money. But buying a company in the UK that only makes £500,000 in profit, you're probably only going to pay, maybe £1.5 or £2 million for it, which is not huge. It's certainly not going to attract the likes of the private equity companies. And as such, Argent constantly filters companies in its widest field to try and acquire. And it tends to acquire companies where regulation in the UK environment tends to play in its favor, such as safety doors, fuel transportation, fire and safety equipment, security. These are never going to change. People will always want security, and health and safety regulation in the UK never goes away. It only gets worse. So I foresee that Argent will continue to pick up nice little businesses, and they've never really overpaid. They've always managed to extract very good profits from a company once it's been integrated. And as I've alluded to in my earlier presentation on Argent, I would not be surprised if in the next few months, a couple more deals in the UK starts to move at 64% rand hedge up towards the 70%. A comment here on York Timbers. Yeah, that's been disappointing. I think we've all seen that share price stagnated around £1.75. I've mentioned on this platform before, the company took a very conscious decision about a year ago to change its biological accounting policy to actually not harvest the trees at 17 years old, to let the trees grow to between 20 and 22 years, because those older trees have a greater degree of linear board meters that can be extracted from a timber that is felled, and more and older timber tends to attract significantly better prices. So sadly, we've got short-term pain for long-term gain. I do not see York actually having any form of capital appreciation for the best part of another 12 to 18 months. So sadly, it's dead money. So for those that want to hang on because of the net asset value, feel free. York to me is not a stock that I would happily want to own as dead money for the next year and a half. I would happily sell the stock and reinvest it into another growth assets. I think you will happily be able to buy the York price back in at least 12 to 18 months at exactly the same price. Again, that's my personal opinion. Do your own recommendation, and certainly do not advocate or follow what I tell you in this webinar. But for me, it's dead money, and I would not want to hang on to it right now. But in many other growth stocks in the current environment, given the GNU, that should benefit better than York. I think York's time in the sun will only come in 2026 and beyond. Rainbow chickens, my last point before before Pascal starts chastising me. It was a talking point of mine in this presentation. I actually met with Martina Stander, the CEO of Rainbow, a few days before the listing on the 28th of June. The stock is now trading at £4.45. Its market value is 3.944 billion rand, and that compares to 7.082 billion rand for Astral Foods. So Astral remains the country's #1 chicken company, producing 5.4 million birds a week. Rainbow is #2 at about 4.5 million. The third biggest is Country Bird Holdings, unlisted. Then we've got Sovereign Foods. Then you've got Daybreak at about 1.4 million birds a week. Then you've got Grainfields, owned by the Free State Co-op, VKB, producing about a million birds a week. So as a context, this country produces 22 million birds a week, of which Astral and Rainbow are #1 and #2, and they produce, between the two of them, roughly, call it, 10 million birds a week. Now, I think it is very good that Rainbow is listed. One, because we've had a dearth of listings in the poultry sector for quite some time. Many years ago, older listeners will know that Rainbow, Astral, Country Bird Holdings, and Sovereign were listed, and now we only have Astral. So for Rainbow to be unbundled from RCL, I think is good news. It brings stability to the market. I do not see any price war because it's in nobody's interest, specifically a newly listed company, to instigate a price war to either gain market share or to try and pick up extra volume, because everybody loses. So I think Rainbow being listed is a very stable factor into the poultry sector. Secondly, the worst of the worst for Rainbow is over. It was caught in the last 3 years with a combination of factors which saw savage volatility in its earnings, from a COVID hangover, the load shedding issue which slammed production. You then have a genetics issue which saw its cob bird not lay enough eggs and affected its underlying production. They then had a transition to Indian River, which has actually occurred, and that is now beginning to benefit the company. And we've now got a slight production uplift from about 4.5 million birds a week, potentially up to about 4.7, 4.8 million. But the key thing I like about Rainbow is that only 24% of its underlying products is tied to the commoditized IQF market, which I said year to date is down 18% in terms of pricing, and 54% of Rainbow's earnings come from food service, which is higher margin, higher value, which is QSR in the food service business, and the value-added products you can buy on the supermarket shelf under the brands of Simply Chicken, Polony, Viennas, Russians, etc., etc. So from a purely mixed basis, I actually prefer Rainbow if I had to be in the poultry sector. But for the same rationale that I said earlier when I discussed Astral Foods and the weakness of a consumer and the current inability to pass on any form of poultry pricing into this weak consumer environment, with input costs having come down but not yet feeding through into the sector, and the underlying nature of a poultry market, I would not be wanting to own poultry stocks currently. There's always a place in a portfolio for chicken companies when you catch the cycle. That cycle is not now. So even though that Rainbow is a newly listed company, and I think in the longer term, it probably will do slightly better than Astral because of its mix, the current positioning of the stock with its trading at £4.45, I think it is purely because the fact, one, there is limited liquidity. Of the near 4 billion rand market value, 80% of the stock is owned by Rembrandt. And then you've got very large institutions having quite large stakes in Rainbow post the unbundling, like Oasis as one example. So there's been some very volatile movements in the share price in okay volume, but I certainly would not be chasing the stock right now. So even though the stock is one I'd like to own, as I said, I would not be putting my own hard-earned money into Rainbow right now. Well, I've gone 5 minutes over my time. There are a few more questions, but sadly I can't come to them. But hopefully when the next webinar comes, probably in late September, early October, I would like to express my sincere thanks to Gary Boysons and Pascal for inviting me to this Rand Swiss webinar. To all the teams at Rand Swiss, please keep an eye on their webinars going forward. To all the listeners out there in the dark, thank you. To those that don't follow me on social media, please subscribe to my Twitter handle @SmallTalkDaily. I do publish constantly on the stocks that I cover and also post my institutional recommendations in full form in the days and weeks after I published them. And from me, keep safe out there. We are in a GNU world. And if the exuberance and positivity that we have seen in the small to mid-cap market, and more so in the mid-cap market, continues, I think that my top 9 stocks will have a equally good second half. And even though much of the easy money has been made, I think that a combination of earnings growth and dividend flow in the second half would or will or should keep the portfolio ticking along, which to date is materially outperforming the benchmarks. From me here in Cape Town with a sleeping dog, have a wonderful Wednesday evening, and I'll see you again soon. Take care.